Hello and good evening, everyone. And thank you for taking the time to be here. And hey, whether you're actively shopping, thinking about buying, or just exploring your options, you're in the right place. And let's be honest, this isn't the easiest housing market we've ever seen. Affordability has been a challenge, and it can feel like they keep moving the goalposts. But here's what's important. This may be one of the most strategic markets we've seen in years. There are more homes available. Sellers are more flexible. And for buyers who are prepared, this is a real opportunity. And that's what we're going to focus on today, and a real clear, practical way to navigate this market and how to position yourself to win as a buyer. And before we go any further, let me quickly review what we're going to cover. We're going to keep this simple, hopefully have a little fun. But what we're going to focus on first is, hey, are you actually ready? This is not emotional. I know looking at homes can be emotional, but the financial aspect should be objective, right? And it should be, hey, what do the numbers tell me and you? Second, how to properly prepare so that this is where most buyers go wrong, right? Most of the challenges that we experience in the mortgage industry through the process is just lack of preparedness. And third, how to win in today's market when you're ready. And if we get those three things right, we believe that you'll have a meaningful experience with us and hopefully make things a lot easier for you and your family and your agent through the process. So, hey, for those I haven't met, my name is Mack Blankenship, aka Mortgage Mack. I'm a managing partner with Rate, husband, grandfather, and seven-time Ironman finisher. And hey, I've also had the honor of guiding visually impaired athletes in the Boston Marathon, National Paralympic Triathlon. And everything I've learned says this, personally and professionally: disciplined preparation creates opportunity. And I've spent 30 years helping families navigate the home ownership process. And I can tell you, post-COVID, I've seen more insecurity, housing insecurity with people that are renting than I've ever seen in my 33-year career. So, hey, I'm sure you've seen this before. Knowledge is power. And hey, you know what? It is true. It is true. And it's the best way to help mitigate the anxiety connected to this process. But we take it a step further. We believe it's not just about knowledge, but we believe in educating you as a buyer so that you feel empowered with the financial decisions you're going to have to make. And that you then at that stage, we believe you'll be prepared. Evidence shows nearly 190 five-star reviews that you will be prepared to execute and have a meaningful experience with me and my team and your real estate agent.
I can't do this anymore. I can't. I give and you take. When I ask you to do something or even fix something for me, you just ghost. But oh, when you need money, you're all over me like all stocky and weird. This is so not working anymore. I need my space. So whatever this even is, it's over. Wait a sec. Does this mean you're not renewing your lease?
Yeah, hey, who wants to shut the door on the landlord? I can't say enough that, rents have been rising. Drop me a yes in the chat, drop me a yes in the comments. Have you seen your rents rise? Because statistics show that just in Texas alone, rents have risen over 30%. But hey, why buy instead of rent? Well, at its core, it comes down to a few simple things. A home is an investment, and research shows that home prices have decreased only 7, maybe 8 times in the last 95 years. Equity: instead of paying a landlord, you're building something that has tangible monetary value for you, your future, and your family. And you know what? Housing stability when it comes to the payment. You don't have that annual, 12-month rental renewal. But look, let's be clear. Homeownership is not perfect. There are responsibilities, there's cost, but renting creates long-term housing insecurity. And I've seen it more today than I've ever seen before in my career. And so the real question becomes, would you rather pay for housing or start building ownership and building equity to achieve your financial goals? One of the first and most important questions you should ask yourself is, hey, am I ready? And it truly isn't a guessing game. It's really an objective answer, and it comes down to a few key items: credit, understanding where you stand. Great idea. Maybe go to annualcreditreport.com, get a copy of your credit report, pay to have the scores delivered. Budgeting, know where your money is going, and more importantly, what you're comfortable with for a monthly payment, while still be able to protect your savings and emergency fund. And speaking of savings, not just for the home, but for reserves, because home ownership comes with responsibility. And it's always a good idea to have a couple of extra months worth of payments in reserves after your closing. And finally, income stability. And I know this can be a challenge today, but hey, feeling confident that your income supports the decision, not just today, but moving forward. And look, we don't have to be perfect with all of these aspects. We just need to create clarity, and we can help you do that. And that's exactly why we put together our first time homebuyer guide. And if you click on the QR code here, it can take you to my website. You can download our free ultimate guide to buying your first home. And this guide is designed to give you clarity so you know exactly where you stand and what to do next. And then, of course, the next step is get pre-approved, not pre-qualified, pre-approved. And I think that whoever you work with, that is a question you want to ask. You want to seek clarity. Am I pre-approved or am I just pre-qualified? Because ultimately you want to be pre-approved so that you can take advantage of the buyer's market. And if there is any competition and they're just pre-qualified and you're pre-approved, they don't stand a chance. So now that we've covered the foundation, let's simplify this and let's walk through some of the core basics. And a common question is your credit really that important? And the answer is yes. And most people think credit simply determines whether you get approved or not. And that's not true. It is much broader than that. Your credit helps determine which loan programs are available to you, your interest rate. It can dictate your down payment and the mortgage insurance. But look, doesn't have to be perfect to buy a home. So don't let this concern you. So the best way to approach this is if you are concerned, annualcreditreport.com, pay for the credit scores, or go to mortgagemack.com, apply there. We do just a soft pull, so there's no impact on your credit score, and we'll schedule some time to visit and review it together. And you know what? Maybe we could just make a few adjustments quickly to put you in the right place to be, maximize your opportunity. And so let's talk about score. And we're going to take this a little step further. Your credit score is sort of tells the story. And, you know, lenders aren't just looking at a number, they're looking for consistency, and that will be reflected in the score. And look, as somebody that used to read 3 credit reports from all 3 bureaus separately, to when they combined all 3 credit reports, we thought that was brilliant. And then when they came out with scores, well, let's just say it's been an enormous time saver for the industry. But generally, what you're looking at for the minimum score requirements on a conventional loan today is 600. Now, traditionally, it's always been 620, but Fannie Mae has removed that score of 620, that minimum of 620, lowered it to 600, and they let the mortgage insurance companies dictate, right? So what that really means is that most mortgage insurance companies, the mortgage insurance is going to be so high, it's not going to make sense to put the minimum amount down. So generally, if you're going to be under 620, you're going to need more down payment. So FHA, hey, that'll go down to 500. Similar situation as the conventional. At below 580, you can expect that requirement is going to be minimum 10% down with reserves. And USDA, well, USDA is not lenient in this area, and they're not lenient on the debt to income ratios. We're going to talk about that here momentarily. 640. And VA, well, it really doesn't have a minimum score requirement, but I tell you that it will be taken into consideration. The score is going to be a reflection of the payment history, and the VA underwriter is going to dive into that. Now, let's talk about some do's and don'ts. And keep your credit card balances low. That is a number one do. And don't use your credit during the mortgage process if you can avoid it. Don't go above maybe 30% of the high credit. And set up payment reminders. Don't miss any payments. Don't miss any payments before. Don't miss any payments during, because we do soft pulls during. We do a hard pull once you have a contract. And then, so we do a soft pull. And if you make a late payment between the interim of the soft pull and the hard pull, we're going to have a problem, a major, major problem. Here's a couple of don'ts. Don't open any new credit accounts while you're in the home buying process. Don't close unused credit cards. This can actually lower your score. And most importantly, avoid major purchases. I've seen it happen. Someone buys a car thinking everything's fine. And there used to be a statistic out there that said, 60% of first-time home buyers bought a new car 6 months to a year before the applied for a home loan. And I've seen it happen repeatedly. Buy the home first, buy the car second. Now, let's talk about down payments. And generally, most people believe, at least depending upon generationally, the belief systems, have maybe aren't as prevalent anymore as they used to be in my generation, but 20% down used to be the minimum requirement until, the government intervened, created long-term amortizations, and mortgage insurance was introduced. So, but now the down payments are flexible. You could do as little as zero down on a USDA loan. You could do as little as 3% down on a conventional loan or somewhere in between. And your exact down payment will depend upon a lot of different factors: the loan program, the purchase price, your financial profile, your debt to income, your credit score. And look, hey, it's not just about down payment. You'll also have to account for closing costs and what we call prepays for an escrow account, which we're going to touch on. And with the right preparation and the right strategy, which we are going to discuss, hey, we're negotiating closing costs, maybe not all of them, but at least a portion, maybe some of the prepaids paid by the seller. We've negotiated interest rate buy downs and other concessions that reduce your out-of-pocket expense. Now, a few years ago, this strategy was not available, and that's what makes this market so different. That's why we believe that if you're a buyer, you feel comfortable, and you believe you're ready, now's the time to pull the trigger. How much can I afford? That is a real question that I get a lot. It's a fair one. But what really drives that more than anything is something we call debt to income and DTI. And in simple terms, it takes your monthly housing payment, which includes principal, interest, taxes, insurance, and homeowners association dues, plus all of your other debts compared to your income. And depending on the loan program, there are general guidelines for conventional loans. It's typically capped around 49.99. So what that means is that if you had $1,000 a month in income, you could not have a housing payment plus car payments, credit card payments, debts only, not utilities, not 401k contributions. Generally, you do not want to see that number exceed 49.99, subject to approval. FHA, same thing, but very lenient, 56.99. USDA, not flexible, 41%. I've seen this in action. Can be super, super challenging if the debt to income ratio is above 41% on a USDA loan. VA, hey, for our veterans, very flexible. We've seen debt to income ratios upwards of 65%. There's other means for measuring the affordability for a veteran, which include the residual income. And, your approval is generally not driven by the sales price. The sales price is a variable of the monthly payment. The monthly payment is what's going to drive the debt to income ratio. So I have people all the time say, hey, what's the maximum I can qualify for? And it's like, let's find a very specific property that you're interested in, and let's measure the debt to income ratio. Because, I can speak in general terms, but with today's information, it really makes a lot of sense to hone in on very specific objective measurements connected to payment. And because in the Houston, Texas market, taxes and insurance can vary significantly from one community to another. Insurance in Brazoria County can be twice as expensive as, say, insurance in Spring, Texas. Um, the taxes, the real estate taxes, can be significantly higher in a newer community than they are in, say, an older community. I live in an older community, and the tax rates are very, very low compared to some of the newer communities that surround my community. So, best thing to do, sit down with someone you trust, bring a property into the conversation, and you know what? We'll build the real numbers together. And generally, what I find is that if we can locate a geographic area, a particular community that you're interested in, then we can arrive at an objective analysis connected to your monthly payment and your debt to income ratio and give you clarity connected to that. So let's talk about what actually makes up your monthly mortgage payment. And it comes down to basically four components, five components: principal, which is, hey, the amount that you pay towards the principal amount of that you've borrowed. The interest, which is the amount the lender keeps for lending you the money. Real estate taxes, we touched on that, can vary tremendously from, in my community, for every $100,000 in taxable value for my home, I pay 2,200. In other communities, it could be as high as 3,600. Big, big difference. Insurance, same thing. And where I live, I have windstorm and hail. I don't have flood, but I have regular hazard. Other communities that aren't close to the coast, they're just only going to have hazard. So big, big different. And again, homeowners association dues generally, range about $50 to $100 a month maximum, unless you're looking at, say, a condominium, gated community, or something of that nature. And, the biggest variable, as I've mentioned here, taxes and insurance. And that's why I believe it's important. Get with somebody you like and trust. Get with somebody that is very, very familiar with how the homestead exemptions are derived in the real estate tax market here in Houston, Texas, and in Texas in general, because those can have a significant impact on your monthly payment. And I've seen people make decisions, seen other lenders make decisions that somebody doesn't qualify for a home when they came back to me, and we were able to utilize, because of our knowledge in the real estate tax records and how those figures are formulated, we were able to help them qualify for the home that they wanted because we were familiar with homestead exemptions, we were familiar with veterans' disabilities, and we were familiar with the over 65. And this is how we move from guessing to empowerment. All right, let's just a little caveat here. What is an escrow account? I mentioned that earlier, and it's generally an account that's held by a neutral third party, and it manages money to make sure everything is handled properly. And there's basically two. There is the escrow for and during the process, where you deposit the earnest money, generally with a third party. And in most real estate transactions, it's going to be with a title company. But before and after closing, a portion of your monthly payment is collected by the lender, and it's set aside so that we can pay your taxes, we can pay your insurance when they are due on an annual basis. And generally, taxes are due in January of the following year, and your insurance is generally going to renew 30 days before your original closing date. All right, so let's talk about loans that fit your life. And, finding the right loan structure can make all the difference in the world as it relates to whether you feel empowered with the decision and whether the lender feels empowered with qualifying you. And first, hey, more fixed rates, it's the most common mortgage. And for many, it's the most comfortable option. Your principal and interest payments stay the same no matter what, forever, for 30 years. And it creates stability and predictability and long-term peace of mind. Your rate isn't impacted by market fluctuations. And it's important to remember, though, your total payments can still change over time due to taxes and insurance. And I'm finding today that is a major issue and challenge for existing homeowners. I had lots and lots of clients come to me and want me to explain why their mortgage payment went up. And it is always directed at taxes and insurance. I had one case, the insurance had gone up from $3,200 to $5,600. That explains a lot, right? And in another case, I had a person that didn't file for their homestead. And because they didn't file for their homestead and get the discount on the taxes, the lender had to pay the taxes based upon the non-homesteaded amount. And 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 what else were they going to do? He didn't file for his homestead. He didn't get the reduction, but the good news is this: he can file now. He can send a certified letter to the servicer, and he can make the exemptions, as I recall, retroactive 2 years. So let's talk about adjustable rates. Very few people make inquiry in regards to this, and this truly is a product from an old timer like myself that has sort of lost its luster. But it's an adjustable rate. We call them ARMs, and they have a fixed period of generally 3 years, upwards of 10 years. Often the rate is lower. And after the fixed period, it can adjust, and it will adjust based upon caps and certain limitations. And generally, I find this to be an acceptable product for somebody that's in a transitional phase. Like I have a doctor, right? And his income is not verifiable in a traditional sense, but there is, a lender out there that will actually lend him the money, despite the fact that he does not have the income that meets the traditional guideline, but they will only do it on an adjustable rate. And they'll give him 5 years to be successful in his career, get the taxes filed, and qualify for a traditional mortgage. That would be a good reason, and in this instance, the only option for an adjustable rate. And next, we're going to talk about loan.
Worry you don't have the funds to buy your first home? Well, don't lose hope until you've checked out all the many programs and resources that can help. Like FHA loans, USDA loans, VA loans, Fannie Mae loans, Freddie Mac loans, the FHA Energy Efficient Program, Freddie Mac Home One, the Chenoa Fund, Community Seconds, and the FHA 203K program. Then there's the National Homebuyers Fund Diamond Program, the VA Renovation Program, Fannie Mae Home Ready, Freddie Mac Home Possible, and even a federal penalty waiver for buyers who tap into their IRA account. Not to mention all the many, many other programs on the state level. And the best way to get a handle on these resources, just call, text, or email your guaranteed rate loan officer today.
Hey, and that would be me. And look, clearly he, I think, answered all the questions connected to this slide. We have lots and lots of programs: jumbo loans, non-QM, conforming, which would be loans directed to Fannie Mae, Freddie Mac, renovation loans, and all the government loans that are out there, down payment assistance loans, local down payment assistance loans. And really the key here is about planning. And we are a believer in educating. And in that education process, we plan so that you're empowered and we know exactly what the plan is so that we can execute through the process. Hey, and this is where things really open up a lot. There are a number of programs designed specifically to homebuyers to reduce their upfront cost. Few key categories that we've already touched on: community lending programs, and these can offer really some extraordinarily great incentives, but they're often tied to specific areas only, and the income limitations are pretty low. And I find that, generally most families, depending upon family size and a multitude of different factors, most families' income exceed the amount, but it's always worth investigating. Get with somebody you like and trust, do the analysis. Government-backed loans like VA and USDA. VA for veterans is 0 down. USDA is for rural areas, 0 down. And affordable housing assistance program, we offer the Texas Department of Housing and Community Affairs. First Texas Home, we offer the Texas State Housing Authority, I think is what it's called again, the Homes for Heroes. And you know what? One of the other items that I really, really enjoy, and I think, I believe if it's being offered by Texas Department of Housing and Community Affairs, the down payment assistance is 2 to 5%, and they offer the MCC credit. And man, let me tell you, if you can qualify for the MCC credit, basically you get 15% of the total tax amount that you paid for the year for as long as you have the mortgage in the form of a tax credit when you file your taxes every year. fantastic. It's the difference maker for a lot of people to choose the down payment assistance programs. And generally, down payment assistance are going to run 2 to 5%. So, moving on. Why Ray? Hey, you know what? Best mortgage company I've
Has your
ever
home purchase
worked
come to a
for.
stop? Guaranteed Rate has an entirely digital mortgage experience that's safe, simple, and secure, even through closing. Find out how today.
Hey, like I said, best mortgage company I've worked for, best technology in the mortgage space. If you don't have our mobile app, go to www.mortgagemack.com, click on the QR code, download our mobile app, wealth of information, and believe with our ultimate guide to buying your home and our mobile app, you will be prepared when you're ready to pull the trigger. And look, we have a super, super high rating in the marketplace. We are number two retail mortgage lender in the country, 97% customer satisfaction, and we are rated at the Better Business Bureau as an accredited business. And me, well, hey, I've been doing this like a long, long time, and I'm the CEO of Team Mortgage Mack. I'm a managing partner with Rate, and we help real estate agents and you, the buyer, win with our educate, empower, execute, and experience. And we call it E to the power of four. And I can say with certainty, with our offer strategy, the Team Mortgage Mack offer strategy, which I'll just sort of summarize it here, but we can discuss it further one-on-one. We can discuss it with your real estate agent. We have seen our offer strategy where we align the financing and the contingencies for the financing with the inspection period, with the idea that when we do the inspection, we're going to have an approval, going to have an appraisal, and we're going to have the inspection. And look, during the inspection period, you can cancel for any reason. So what we've been able to do successfully is remove all of the financing contingencies. And when we have run into a problem, and a great example is last year we had an appraisal come in $50,000 low, meaning the sales price was 580, but the lender's report for value came in at 530. Big disparity. In many, many markets and in many, many situations, the seller's just going to move on, cancel the contract. But at that moment, we have a borrower that's approved, a bona fide appraisal from a federally licensed appraiser, and a inspection report. And so we presented that information with a counteroffer to sell us the home at 530 instead of 580 and a termination agreement. And we won $50,000 off of that sales price. And I can tell you, we can do the same thing for you. So if you believe you're ready, click on the QR code, go to mortgagemack.com, apply. I'll receive an email as soon as you reply, and we will get in touch with you, and we'll schedule a Teams meeting, Zoom meeting, and help you build a plan to win in this market. Thank you.